Turning to one of our top stories today, the Federal Reserve suggests it could pivot next year on interest rates. For now, it's keeping the benchmark rate between 5.25% and 5.5%. But policymakers signalled in their so-called dot plot that rates will be cut in 2024. And US stock markets have soared as a result. Vanguard is one of the world's biggest investment management companies, and it expects rate cuts in the second half of 2024. Okay, let's discuss what happened today. Joining us now, Joseph Davis is Global Chief Economist at Vanguard. Joseph, great to have you with us. What do you make of what we heard from the Federal Reserve? They inched further on rate cuts next year. We're now talking, 3/4 of a percentage point, all being well. The market, however, is now expecting double that in terms of cuts. Something's got to give.
I think you've nailed it on the head. I mean, I think what we heard from the Federal Reserve, they're gaining confidence in the outlook, which is of inflation continuing to come down, and that they believe that we don't need to see any really material weakness in the labor market in 2024. That's what some refer to as a soft landing. I think we certainly agree in the sense of there's room for it to cut in the back half of next year. But something has to give. I mean, I think the soft landing narrative is a bit naive. It's overly optimistic, and I think the Federal Reserve has to watch feeding animal spirits too much in desiring to cut rates too soon.
So what does that mean, Joseph? I mean, Jay Powell obviously has now been speaking for what he's talked for an hour to try and push back, I think, on some of those expectations. He's done his best, and this is not the first time where he's suggested sort of hold your horses in some respect, and they're still data dependent. That will be the case, I guess, into next year. Data dependency, watch the data, and we'll see how it goes. We'll cut as much as we can, but not too much, to your point.
Sure. I mean, again, I think, the market is craving, in many ways, the pre-COVID world of very low interest rates. We believe that sort of diagnosis is just incorrect, that we've entered a modestly higher interest rate world. You can still have central banks such as the Fed easing in 2024, but this is a clear positive for investors. I think, the market at times can favor too much, desire too much near-term movements, but longer term, we've entered a higher interest rate world. Again, I think the Federal Reserve has to keep an eye on the labor market. I'm not saying that they're not, but they made a mistake over 50 years ago of cutting rates too early. It was one of the few times in U.S. history we've had a so-called soft landing in 1967. Unfortunately, a year and a half later, they were raising rates aggressively because the labor market resurged and inflation came back. That is not our baseline expectations. But when I see the market's reaction today, I start to wonder.
Yeah, I mean, you've been long talking now about a return to what you call sound money, and that's when interest rates are above inflation. So real interest rates, as we call them, are then positive. And the good news is it means you actually earn money on assets that aren't inflated away by rising prices. This should also be good for returns. And to your point, we've not really seen this for 10, 15 years. What does it mean for investors, or what should it mean for investors?
Well, I think the solace for all investors, in my mind, this is the single best financial market development in over 20 years. It wasn't that long ago when all the world, we were, facing zero interest rates, near zero interest rates. And so that compounding effect in your portfolio with rates, maintaining above the rate of inflation, as you mentioned, Julie, that will continue to be a positive force going forward. Again, we're going to have ups and downs of the business cycle. But if we look back 10 years from now, back 10 years, I think we're going to be really pleasantly surprised by the change in trajectory for investors.
I read this weekend that 61% of Americans now own stocks, and that's the highest it's been for, a couple of decades. It's clearly not part of the Fed's mandate. As you said, they're focused on the labor market and on inflation. But when you know that significant a proportion of Americans own stocks, you sort of have to factor in asset prices, beyond the traditional, which I think would have been housing, of course, into what happens when you make these moves. Does it put the bias more on protecting that, perhaps, than being willing to risk a recession, and therefore perhaps you'd cut more quickly than you otherwise might have done?
I think it's a really good point. I think that's where the tension is, and I respectfully, worry sometimes about central bankers reacting too quickly to financial conditions. Now, again, central banking's a really tough job. That said, I would look less at the computer screens in terms of the S&P 500, and more in the economic fundamentals. So again, I think if we go into next year, we're going to have a labor markets that's downshifting. But I have one eye on what happened, over 50 years ago, and you have to normalize, because if not, we're back in the same mess, that we were in a year ago. Different somewhat, but nevertheless that tension. So again, I think it's steady as she goes in the near term for the Fed. We have not seen enough evidence one way or the other to start cutting.
Yeah, and it's so important, Joseph, because it spills over into society and into bad feeling. It's not just about the economics. It has far greater implications, and I agree with you. We can't go back there. Great to chat to you, Joseph Davis there.
Thank you.
Thank you.